Hello, welcome back. This is Si Win Yi, and today's I'm going to cover a lot of great high-level topics, which I think many of you will clearly enjoy. So enjoy the ride because I'm going to cover a lot of information on this, so maybe 15-minute video presentation. And before I begin, if you go all the way back toward the end of this presentation, if you see value of this video, please smash the like button and also subscribe to my channel. I'm trying to grow my YouTube channel, which is not easy, and I'm trying to improve on my presentation. So it's not easy to be in front of the audience, but I am trying to overcome obstacles. So hope you understand. So it's a big journey. All right, so let me share the screen, and the topic is very interesting. So I'm going to use the Fannie Mae real estate housing forecast for the next 2 years, 2023 and 2024, Fannie Mae. All right, and the title is Growth Expected to Resume After a Mild Downturn in 2023. So the yellow highlight is pretty much just, I want to emphasize some of the important highlights with the yellow thing. Otherwise, I don't want to read word by word. It'll be very boring. So here are the highlights from Fannie Mae. This is the first month that our forecast includes a 2024 outlook. So not too many news media are projecting housing forecasts 2 years into the future. So Fannie Mae, as far as I'm concerned, is the first organization that are using a projection so far ahead. So remain to be seen how accurate they are going to be. So here's the highlight of the first paragraph. We still expect a modest recession to begin in the first quarter of 2023, which is only a few months away. So as the full effects of tightening monetary policy and weaker global growth weigh on the economy. And it says on the 2024 home sales forecast, Fannie Mae projects total sales of 5.25 million units, up 18.6% from our forecast for 2023. And it also say that ongoing housing supply deficit helping drive the new home sales. So again, reflecting on the expectation for modest pullback in mortgage rates and a broader economic recovery as well, and an ongoing housing supply shortage. So as you know, we are seeing a very steep decline in home sales and supply of home inventory relative to modest demand. So moving forward, you must understand economics 101, demand and supply equilibrium, right? So just keep that in mind as we are going into the next year, 2023 and beyond. So economics 101 means if demand is higher than supply, then we will have housing price increases. So keep that in mind. Look at the trends. All right, home sales are projected to hit a trough in second quarter of 2023, which is April, May, and June 2023. We're talking like 5 months away. Wow, time flies, right? So furthermore, the home sales are projected to hit a trough in quarter two 2023 at a selling pace of 4.27 million analyzed units as the full effect of higher mortgage rates and projected recession take hold. Okay, so let me see what else I can highlight here. Okay, in fact, let me finish up on this paragraph. It should be noted, however, that following the most recent consumer price index CPI report, longer run interest rates fell by about 30 basis points recently compared to when our interest rate forecast was completed, suggesting some upside risk to our home sales forecast over the coming quarters. All right, let me scroll down here to see what other important highlights on this very, very long, detailed, very data-driven article. And so, meanwhile, residential fixed investment continues to decline sharply. That means, in layman's term, home sales has declined sharply this year, 2022, falling at a 2.64% annualized rate in the third quarter of 2022. So pretty steep drop. And let me see what else. According to Fannie Mae, also, the home purchase sentiment index, which consumers now expect home values to decline over the next 12 months. Again, American consumers, a survey was conducted recently. The majority of American consumers, prospective home buyers and what have you, they have a very pessimistic view of buying a home. So therefore, the home purchase sentiment index was created for that reason. So it's really a psychological effect, if you will, right? And so is it, home purchase, just like a lot of things about money, is psychological. And so this will likely contribute to a slower consumption growth because of the negative, quote, wealth effect, end quote. Wealth effect, negative wealth effect, in which households are less likely to dip into savings or take on more debt because they feel that their assets are declining in value. Okay, so people, in layman's term, or consumers, prospective home buyers are sitting at the sideline because they have a negative view about housing. They don't want to buy a house which is, in their mind, are going down in value. So a lot of people stay on the sidelines, hopefully expect things to get better in the near term, right? So taken together, we expect a modestly negative quarter for 2022, which is going on right now, 1 more month left, December, GDP, okay, gross domestic product print, due to softening consumer spending, declining residential fixed investment home sales, and stabilization in net imports. So one major area pointing to continued economic strength is the labor market. So that's good news, right? Let's go over some good news. In October last month, 2022, there were 261,000 jobs were added, bringing a total gain of, in 2022, to more than 4 million jobs. Furthermore, there's an additional 437,000 new job vacancies, companies begging to hire more people, but people are not accepting those new job vacancies. So the saving grace about this recession is that this potential recession is that at least the economy and the job market are still, going pretty strong. That will, in my opinion, will help the modest recession that we are about to occur. All right, so let's scroll down here, and the most notable difference in the labor market between past recessions and the current conditions is the level of labor market gains, which is more than triple the average of past recessions. So what this means is, historically, in the past recessions, there were much more negativity around the job market, higher unemployment, more people were looking for jobs from the past major recessions, especially the 2008 housing crash. But this impending recession should be very mild, should be very short indeed. So that is, in my view, is a very optimistic view, in my personal opinion, that this recession is going to be very mild. It could be fairly short, 9 to 12 months in estimation. So it's not, the worst is not the economy is not crashing, the housing market is not crashing. It's just that going through a typical correction that we're going through with housing especially. All right, so the next paragraph, not out of the woods yet, but inflation may have peaked. So that's really good news, right? Because the Federal Reserve has been raising the interest rate to in order to combat inflation. If inflation has peaked, I don't see any reason why the interest rate the mortgage rate could be higher than 7%. No one knows for sure. I don't have a crystal ball, but if inflation has peaked, that means the interest rate should be stabilized. Currently, as I'm recording this, the mortgage rate is around 6.6 to 6.8%, 30-year fixed rate mortgage. As I'm recording this in the third week of November 2022. So while monthly inflation data can be volatile, it has been in a case recently, there are signs in this report that inflationary pressures may be easing broadly. So that's good. That's very good news. The inflation could continue to go down. You have to expect that the mortgage interest rate may go down. So that's what I think is going on. So looking at overall inflation from top-down approach also suggests further annual deceleration. So that means the interest rate could go lower, little by little. So as I stated. All right, let's get back to the core. The home sales expected to continue to decline. Home sales, not home price reduction. Okay, you have to understand the wording, the terminology. So home sales, not home prices. According to National Association of Realtors, existing home sales continue to trend downward, falling 1.5% in September to a season-adjusted annual rate pace of 4.71 million units. Pending sales, which is very correlated to declining home sales, pending home sales, which had led closing on average of 30 to 45 days, also fell 10.2% in September 2022. So pending sales are decreasing, and then after listings is decreasing, and new listing is decreasing a month over month toward the past 2 quarters of this year, 2022. Then we're seeing very, very low inventory due to the higher interest rate. So Fannie Mae will forecast that total existing home sales will be a little bit over 5 million in 2022, 3.9 million next year, 2023, before rebounding in 2024 to a pace of 4.6 million. All right, so let that sink in. I'm going to show a graph, a data momentarily to go over more details of this very interesting projection by Fannie Mae, why 2022 existing home sales 5 million, then drastically reduced by more than a million projection in 2023 to 3.9, then go skyrocket back up to 4.6 million in 2024. That is a very, very ambitious numerical projection by Fannie Mae. So I have some personal opinion about that. So it's not going to be a good one. So with mortgage rate continuing to rise over the past month, the 30-year fixed rate mortgage was 7.08 in November 10th. Of course, as you may realize, it has the interest rate has gone down pretty in a 40-year low over a 1-week period to 6.6% or thereabout as of right now. Don't quote me on it. I'm being pretty close. So the full effect of the rate increases on home sales have yet to be felt. That means the lagging indicator. It takes several months of lagging indicator to determine the actual result of anything happening, for example, today, especially with interest rates. So everything is lagging. 2 months takes a house to close escrow. That is the lagging indicator. And any kind of current most up-to-date report. Even though I'm talking to you in the third week of November, the latest data any news media has is like September to October timeframe, the last data year to date. Okay, and the biggest challenge for home buyers or first-time home buyers, I mean, right, that's pretty obvious because that's the most challenging aspect. First-time home buyers will be have the hardest time buying a new home because of the larger effect of the total home sales is going locked-in effect. This means the existing homeowners, they are locked in, right? Albeit they call it locked-in effect. They have the current homeowners, they have disincentive for existing homeowners with a fixed rate mortgage that is well below the current market interest rate to put their homes on the market, move and take on a new mortgage well above what they had previously. So, right, if 80% of the current homeowners have a mortgage rate of less than 4%, why would they sell their home, buy a new or upgraded home for 6.5% to 7%? I mean, that's crazy. They have very little motivation or incentive to do so. They're locked in at the historical low interest rate. So, the bearish outlook in 2023 for existing home sales, as I said, we are now projecting Fannie Mae the lowest annual pace since 2008, the last housing crash. So, right, so you understand what I'm saying. It's just that moving to 2023, we're gonna continue, if the interest rate continue to be at this level, 6 to 7%, we're gonna see the lock-in effect. The existing home sellers are not gonna sell, and thereby exasperating the historic low inventory of supply of homes out there. All right, so this is the dynamic. So the 30-year fixed rate mortgage, like I said, 80% of the existing homeowners have mortgages at least 200 basis points, because 100 basis point equal 1%. 200 basis points equals 2%. So if today's interest rate, for example, mortgage rate that is 7%, 200 less basis point is 2% lower, which is 5%, right? If today's rate is 6.6%, 200 basis point less is what? 4.6% interest rate. So now you know, understand the 100 basis points equal 1%. So more than 90% have mortgages of at least 100 basis point lower. So this is by far the largest share since at least the year 2000, which is almost 23 years ago, and likely the largest since the late 70s. We're talking 50 years ago. So Fannie Mae is telling you that in the past 50 years, there are more homeowners today that have such a disparity of a low historical rate of mortgage on their current home than the ongoing current mortgage rate, thereby creating this new terminology, the lock-in effect. So sellers are sitting on their historic low mortgages. They're not going to move, so that's gonna hurt the supply of inventory for the foreseeable future. So Fannie Mae therefore forecasts a mortgage rate to pull back somewhat over the next 2 years. Pullback means hopefully lower the rate, pullback. This partially reflects a view of moderating 10-year Treasury rates as the Fed eventually ends its tightening stance, a contracting economy, and the compressing of the Treasury mortgage rate spread once interest rates stabilize. That means the Fed, the central bank is the one that creates the interest rate, and they use the 10-year Treasury. That 10-year Treasury is the is the barometer, is a trigger to determine the mortgage interest rate, not the Federal Reserve. 10-year Treasury rates are expected to be stabilizing, and therefore interest rate in the next few years could very well decrease. By how much, we do not know. That's the $1 million question. So when this happened, when the mortgage interest rate start to decrease little by little in the foreseeable future, this will eventually help spur a rebound in sales, obviously. So until then, the lock-in effect is going on for existing homeowners will remain in their home in a way that has not occurred in over 40 years. Fannie Mae expect this could limit overall home sales over the next business cycle. Yes, that is true. All right, so the month supply of the existing homes has trended upward over the past year, remaining at 3.2% for the past 3 months, though it's up from a recent low of 1.6 in January. This is amazing, right? Economics 101, right? What is the balance equilibrium inventory? 5 to 6 months available supply inventory is a balanced market. This year, earlier this year, yeah, is right now is like 3.2%, which is still a very low imbalance between demand, supply, demand. Supplies are very low relative to demand, even though demand has had a big pullback, right, as a result of the higher interest rate in the past 6 months, but still at a historical low at 3.2, and even at the year 2020, 2021 and 2020, at the peak of the pandemic real estate boom, we have supply inventory of 1.6 months, which is historical low in inventory. Okay. All right, so yep, this largely due to lower sales rather than an increase in the flow of homes. Okay, so 3.2 supply of monthly inventory, even though we have increased inventory lately, but it's due to a pullback in demand, not necessarily more homes are coming into the supply side of the inventory. According to Redfin, which I referenced quite a bit on my videos in case you have not noticed, after trending upward over the past summer, the weekly trend in new listings has slowed and is at least 17% below the pace from a year ago. So new listings is going down. The resale homes, current homeowners are not selling, they are staying put. And so Fannie Mae, we suspect this is in part due to would-be move-up buyers deciding not to list the existing home for sale, given how high the current rates are. Okay, so I'm just validating everything. So first-time home buyers may increasingly turn to new homes in coming years, as even fewer existing homeowners put their homes on the market. So first-time home buyers out there, you are relying on home builders, the new home builders, to buy your homes. But therein lies another problem. In the near term, new home sales continue to slow because builders have overbuilt based on the demand equation recently, the past 9 months. So as a result, the August of 22 jump coincided with the temporary pullback in mortgage rates over the summer, as well as reports of more aggressive incentives on the part of home builders. So because of there's a glut of inventory with new construction homes, builders are providing more incentive, right, to home buyers, to cover the reducing the home price slightly, 5 to 10% maybe, depending on what market, and they are helping you buy down the rates. They're helping you pay for your closing costs. So a lot of good incentive by the builders to get rid of their remaining completed home inventory. So as you can see, anticipate more aggressive discounting and incentives going forward as home builders try to move available inventory. So therefore, we project new home sales to hold up comparatively well relative to existing sales in coming quarters. So that implies that the lack of current homeowners not selling their existing homes hopefully are offset by available new construction homes for sale, especially for the current home buyers. But the problem I'm seeing is that a lot of the new construction homes are not entry level. They are, depending on what market in the U.S., but the home builders they are building more homes past the $400,000 range, 400,000 to 1 million, right? So entry level homes are new homes that is are anywhere from like 200,000 to 400,000, which is could be affordable for the first time home buyers, since new builders all over the country are not building lower cost entry level homes. That is affecting the first time home buyers more than any other demographic groups. So this is a big problem. Okay, so home sale forecast. In particular, we expect 1.64 trillion in single family purchase mortgage originations in 2022. But look at this, much a decrease to 1.34 trillion in 2023, down 18.5% year over year. So Fannie Mae projecting a lot less mortgage purchase originations because of the lack of sales, lack of home purchases. All right, so then we expect purchase volume to return to 1.5 million in 2024 as home sales are forecast to rise again. Yeah, we'll see about that. For single family refinance origination, we expect 699 billion in 2022, but only 375 billion in 2023. Drastic reduction, right? A big downgrade. So Fannie Mae expect refinance volumes to grow to 538 billion in 2024 as mortgage rates are projected to decline somewhat over the past year. Okay, we'll see. All right, for that reason, let's segue to this Fannie Mae housing forecast November 2022, which is very interesting. So I need to look into this graph so I can this is a very important graph that you really need to know. This is very interesting. Okay, so let me put my reading glass on. According to seasonally adjusted annual rate, according to Fannie Mae, the 2021 total housing sales last year was 1.6 million, up 16% year over year from 2020. And 2022, the total housing units starts was 1.5 million, 1.545, down 3.5% from 2021. Okay, that's understandable. Now, look at the 2023 projection. The total housing starts are lower to 1.137, which is like a whopping double-digit 26.4% reduction of housing starts from 2022. So 2023, according to Fannie Mae, is not going to be a good year based on their projection. So until 2024, Fannie Mae predict that the housing stock will increase to 1.2 million, which is equal to 8.6% increase from 2023. All right, so single family home. This is also very interesting. In 2021, last year, there were 1.1% of single family home starts, which is up 13.8% from 2020. Then 2022, this year, as we're about to conclude this year, the single family housing starts is 1 million, down 10% year over year from 2021. And then next year's projection, Fannie Mae predicts 759,000 single family home starts, which is a whopping almost 25% year-over-year percentage change from 2022. So 2023, according to Fannie Mae, is going to be a terrible year. And then, but they have another optimistic projection for 2024. Single-family units are projected to be 875K, which is 15% year-over-year higher than 2023. All right, so total home sale, again, including the multi-units, 2021 is 6.8, 2022 is 5.6, a drastic reduction of 2023 is 4.4, and then go back to 5.2 of total home sales, including all type of units. So I'm very, very skeptical of those data, but even makes me more skeptical. Look at down here. Focus on the projected mortgage interest rate, percent of quarterly average annual on a 30-year fixed rate mortgage. This is critical. You must understand. Pay attention if you have not been already. As we know, 2021 is a historical low interest rate. Therefore, everybody made huge amount of equity. The average interest rate, mortgage rate in 2021 is a historical 3%, right? Then 2022, the projection as we finish out the year, the mortgage rate is 5.4%. Okay, still fairly low this year, but it's trending upward, as we all know, which is not a good sign with the mortgage interest rate. The projection, look at this. This is mind-boggling. I do not agree. The Fannie Mae projection for 2023 next year on the 30-year fixed rate mortgage, 6.8%. That is mind-boggling. And then that's why they have all this double-digit reduction of sales and units and everything else, right? You see, minus 29, minus 22, minus everything throughout 2023 projection by Fannie Mae. Now, furthermore, now this is really even more critical. Then look, 6.8%. I mean, housing transaction is not going to go anywhere. We witnessed the past 6 months of 2022. The past six to 9 months, when the interest rate, mortgage rate increased from 3.5% early this year, the first quarter of 2022, to now to like almost 7%, which is skyrocketing interest rate change, and that's why we have the dynamic where sellers not selling and buyers not buying because of home affordability factor. So the home transaction the past 6 to 8 months has been static, has been like a non-existing at a 7. And then if Fannie Mae project the year 2023 to be continue to be 6.8%, we're going to see the same paralysis, same no transaction. It'd be just like the last 9 months. So, and then look at 2024 projection of the interest rate by Fannie Mae, 6.1%. You look at the differences in the numbers. At 6.8%, we have double digit in reduction of home starts in terms of percentage change from the prior year. And then Fannie Mae projects 6.1% mortgage interest rate for 2024, and they expect homes to increase. Look at this. Okay, let me look at this. At 6.1% mortgage rate projection for 2024, Fannie Mae thinks that there will be a 8.6% increase in total housing starts. They project 15.8% positive increase in single-family home start year over year from 2023 to 2024. And then they expect total home sales, including single-family homes, condos, co-ops, multifamily, 5.2 million 2024, up 18% year over year. And the decrease at existing home sales, single families and condos, 18% increase year over year from 2023 to 2024. And you think a 6.1% mortgage rate, you expect people can come back into the housing market and start buying at 6.1%? I don't think so. Look at the variance. If the projection is correct, 2023 interest rate 6.8, 2024 projected interest rate 6.1. We're talking only about like a 0.7 percentage increase. This is not going to move the needle. A decrease from 6.8 projection mortgage rate in 2023 to a 6.1 mortgage are not going to move the needle. What I mean by that, that means the the home buyers, they're not going to jump into the market at 6.1 at maybe 5.5 or 5% mortgage rate. Yes, I see a housing frenzy, a transaction frenzy. I see the lock-in effect of homeowners some of them may sell because they don't mind selling a home at 5.5%, but not 6.1. You're not going to move the needle. Look at this. The projection from 6.8 to 6.1, all this double-digit increase back to normalcy from all this data here, it's just not going to happen. So, look, projections forecast of forecast. Some organization. Here's the bottom line. Okay, I know this video have taken much longer than usual, but you must agree that I'm providing you with a lot of data. So, in order to move the needle for mortgage interest rate, it may not happen for 2023. 2023 will be a sort of a wash year, if you will, a wash housing activity. But 2024, in order to have any kind of positive increases in home sales, listings, and sellers finally selling, the mortgage interest rate has to be lower than 6.1. Got to be like 5.5, maybe even 5% to see any resemblance of back to normality. Right? So that's my recap. So sorry for taking so long. All right. Anyway, I got to go. So thank you for listening. Hopefully you can receive a lot of value from this. If you did, please smash the like button and also subscribe to my YouTube channel, and also enter my subscribe to my email newsletter. So I specialize in normal people out there, normal Americans to become a real estate investor. So subscribe to my website below, enter your email on my database, on my newsletter, so you will receive weekly great information about real estate investing, especially for the average person out there in the country. Thank you so much. This is Stephen Yi. Thank you for listening, and I'll see you on the next video. Bye-bye.